Imagine this for a moment. You turn on the TV, open YouTube, or scroll through social media, and everyone is talking about the next hot stock. One person claims they doubled their money in a week. Another says they found the next Apple or Tesla. It sounds exciting, fast, and glamorous. But here's the uncomfortable question most people never ask. If picking individual stocks is so easy, why do most investors still lose money over time? Now let me tell you something surprising. One of the richest investors in the world, a man worth over $100 billion, does not recommend that most people pick individual stocks. Yes, I'm talking about Warren Buffett. The same Warren Buffett who built his fortune by buying great companies does not believe that average investors should try to copy him. Instead, he strongly recommends something far simpler, calmer, and frankly, boring: index funds. So why would the greatest stock picker in history tell everyday people not to pick stocks? That's exactly what we're going to break down in this video. Warren Buffett has been investing for more than 70 years. He's seen bull markets, crashes, bubbles, and financial disasters that wiped out millions of investors. And after all that experience, his message to regular people has stayed shockingly consistent. He believes that time, discipline, and low-cost index funds beat stock picking for the vast majority of investors. Let's be very clear about one thing. Buffett is not saying individual stocks are bad. In fact, his own company, Berkshire Hathaway, owns massive positions in companies like Apple, Coca-Cola, and American Express. But here's the key difference. Buffett has a full team of analysts, decades of experience, and access to information and patience that most people simply don't have. He knows that trying to copy his strategy without his skills is a dangerous game. This is where most beginners make their first big mistake. They see Buffett's success and assume, if I just pick the right stocks, I'll get rich too. But Buffett himself has warned again and again that even professional fund managers failed to beat the market over the long term. And if professionals with Ivy League degrees and billion-dollar resources can't do it consistently, what are the odds for an average investor working a regular job? This is why Buffett often says that investing is not about being smart, it's about avoiding stupidity. Overtrading, chasing hype, panicking during crashes, and paying high fees are the real enemies of wealth. Index funds, by design, protect you from most of these mistakes. An index fund simply tracks the overall market, like the S&P 500. When the best companies in America grow, your investment grows with them. You're not betting on one company to succeed. You're betting on the entire U.S. economy over time. And historically, that has been a winning bet. In fact, Warren Buffett once made a famous bet that a simple S&P 500 index fund would outperform a group of high-fee hedge funds over 10 years. And guess what? The index fund won. That bet perfectly explains his philosophy. Simplicity beats complexity, patience beats prediction, and consistency beats excitement. So in this video series, we're going to compare index funds versus individual stocks exactly the way Warren Buffett looks at them. We'll explore why index funds work so well, when individual stocks might make sense, and what strategy Buffett himself wants his own family to follow after he's gone. Because at the end of the day, the goal of investing is not to brag about winning a lucky trade. The goal is to build long-term wealth with the highest probability of success. And according to Warren Buffett, for most people, the smartest path is far simpler than they think. To understand why Warren Buffett strongly favors index funds for everyday investors, we need to talk about something most people completely underestimate: probability. Investing is not about what can happen. It's about what is most likely to happen over a long period of time. Buffett doesn't build wealth by chasing possibilities. He builds it by stacking the odds in his favor. When you buy an individual stock, you are making a very specific bet. You're betting that one company will outperform thousands of others. That means you need to be right not just once, but consistently. You must correctly analyze the company's financials, management, competitive advantage, industry trends, and future risks. And even if you do everything right, things outside your control can still destroy your investment. New regulations, technological disruption, scandals, or economic shocks. Now, compare that to an index fund. When you invest in an S&P 500 index fund, you are not trying to predict which company will win. You automatically automatically own pieces of the 500 largest and most successful companies in America. Some will fail, some will struggle, but others will grow massively and replace them. The index constantly evolves, and you benefit from that evolution without having to make any decisions. This is one of Buffett's most important ideas. You don't need to know which companies will succeed as long as you own the winners when they emerge. Index funds do this automatically. Another major reason Buffett loves index funds is cost. Most people ignore fees because they seem small. A 1% or 2% fee doesn't sound like much, but over 20 or 30 years, fees can quietly destroy hundreds of thousands of dollars in potential wealth. Buffett has repeatedly warned that Wall Street makes more money from investors than investors make from the market itself. Index funds are extremely low cost. Some charge less than 0.05% per year. That means more of your money stays invested and compounds over time. And compounding is where real wealth is built. Buffett often says that his wealth didn't come from being brilliant, but from being patient for a very long time. There's also the emotional side of investing, which Buffett believes is the biggest enemy of all. When people buy individual stocks, emotions take over. They panic when prices drop. They get greedy when prices rise. They sell at the worst times and buy at the worst times. Studies show that the average investor underperforms the market largely because of emotional decisions. Index funds reduce this problem. Because you are not focused on one stock, you're less likely to panic. You're more likely to stay invested during market crashes, which is exactly when long-term investors should be buying, not selling. Buffett has famously said that market crashes are not disasters, they are opportunities for disciplined investors. In fact, Buffett has been so confident in this philosophy that he publicly stated what he wants done with his own money after his death. He instructed that 90% of his wife's inheritance be invested in a low-cost S&P 500 index fund and only 10% in short-term government bonds. Think about that. A man who mastered stock picking wants his family to use index funds. That alone should make people pause and think. Now, does this mean individual stocks are useless? Not necessarily. Buffett himself invests in individual businesses because he understands them deeply and has the temperament to hold them for decades. But he knows that most people don't have the time, discipline, or emotional control required to do this successfully. This is why Buffett's advice is so powerful. He doesn't tell people what sounds exciting. He tells them what works most reliably. Index funds remove the need for constant decisions, reduce mistakes, minimize costs, and allow the investor to focus on the one thing that truly matters, staying invested for the long term. In the next part, we'll dive deeper into when individual stocks might actually make sense, who should consider them, and how Buffett himself approaches stock selection differently from the average investor. By now, it should be clear why Warren Buffett believes index funds are the smartest choice for most investors. But this leads to an important question. If index funds are so powerful, then why does Buffett himself still invest in individual stocks? The answer lies in one word that most people ignore: difference. Buffett is not investing like the average person, and that difference changes everything. Buffett does not buy stocks the way most people do. He does not chase trends, trade frequently, or react to headlines. Instead, he approaches stock investing as if he were buying an entire business. He studies companies for years, sometimes decades, before investing a single dollar, and once he buys, he's prepared to hold that company forever, as long as the business remains strong. This is where individual stock investing can make sense, but only under very specific conditions. First, you must deeply understand the business. Buffett has often said, never invest in a business you cannot understand. That means knowing how the company makes money, why customers choose it, and what protects it from competitors. This level of understanding takes time and effort that most people are unwilling or unable to commit. Second, you must have an extremely long-term mindset. Buffett is not interested in what a stock will do next month or even next year. He cares about what the business will look like 10, 20, or 30 years from now. Most investors fail because they think like traders, not owners. They sell when prices fall and buy when prices rise, the exact opposite of what Buffett does. Third, you must have emotional discipline. Individual stocks are volatile. Even great companies can lose 30%, 40%, or 50% of their value during market crashes. Buffett has experienced this many times. The difference is that he does not panic. He understands that price volatility does not equal business failure. Most people, however, however, confuse falling prices with bad investments and sell at the worst possible moment. Buffett also focuses heavily on what he calls economic moats. These are competitive advantages that protect a company from rivals. Strong brands, network effects, cost advantages, and customer loyalty all create moats. Companies like Apple, Coca-Cola, and American Express have these characteristics, which is why Buffett feels comfortable owning them for decades. Without a moat, even a fast-growing company can quickly collapse. Now here's the part most people overlook. Even Buffett admits that finding these kinds of businesses at fair prices is extremely difficult. Opportunities like this do not appear every day. Sometimes Buffett sits on cash for years, waiting patiently. The average investor does not have this patience. They feel the need to always be doing something, which usually leads to bad decisions. This is why Buffett believes individual stocks should only be considered by people who meet very strict criteria. They must be willing to study businesses deeply, hold through extreme volatility, ignore market noise, and accept that they may underperform the market for long periods of time. For everyone else, index funds provide a much higher chance of success with far less stress. In simple terms, Buffett uses individual stocks to concentrate wealth, but index funds to protect and grow wealth. Most people should focus on growing and protecting their money first, not trying to hit home runs. In the final part, we'll bring everything together. We'll explain exactly what strategy Warren Buffett recommends for the average investor, how to combine simplicity with discipline, and what you should realistically do if your goal is long-term financial freedom.
Now let's bring everything together, because this is where Warren Buffett's advice becomes extremely practical and powerful. After decades of investing, billions of dollars in returns, and witnessing countless investors fail, Buffett's message to the average person is surprisingly simple. He believes that investing should be boring, consistent, and long-term. If it feels exciting, fast, or emotional, you're probably doing it wrong. Buffett's recommended strategy for most people is not complicated. First, regularly invest in a low-cost S&P 500 index fund. This gives you ownership in America's strongest businesses and allows you to benefit from long-term economic growth. Second, stay invested no matter what the market is doing. Market crashes, recessions, and fear are not signals to quit. According to Buffett, they are part of the journey and often the best opportunities to invest more. He often says that the stock market is a device for transferring money from the impatient to the patient. This single idea explains why index funds work so well. When you consistently invest and give your money time to compound, you allow mathematics to work in your favor. You don't need perfect timing. You don't need secret information. You just need discipline. Buffett also strongly advises avoiding unnecessary complexity. Many investors believe that more effort equals better results. In reality, complexity often leads to higher fees, more mistakes, and emotional stress. Index funds eliminate these problems. They don't require constant monitoring. They don't rely on predictions. They simply allow you to participate in the market's long-term upward trend. So where do individual stocks fit in? Buffett would say that if you truly enjoy studying businesses, understand financial statements, and can remain calm during extreme market volatility, then a small portion of your portfolio could be allocated to individual stocks. But this should never be the foundation of your strategy. For most people, individual stocks should be optional, not essential. Perhaps the most powerful endorsement of this philosophy is Buffett's personal decision for his family. Despite mastering stock picking himself, he wants his wife's inheritance invested mostly in an index fund. That tells us everything we need to know. His advice is not based on theory, trends, or opinions. It is based on real-world results. In the end, Buffett's message is not about becoming rich quickly. It's about avoiding big mistakes and letting time do the heavy lifting. Wealth is built slowly, quietly, and patiently. And for most investors, the simplest path is also the smartest one. So if you're trying to decide between index funds and individual stocks, remember this: you don't need to be a genius to build wealth. You just need a strategy that works, the discipline to stick to it, and the patience to let it grow. And according to Warren Buffett, that strategy starts with index funds.